All righty, Aphrodite, we are back live, coming to you live from the studios in a house. This is 101.5 FM WLCB, Slade's Corner, Wisconsin. My name is Bill Miksch. I'm president of WDMA Financial Group in Grayslake, Illinois, where we have clients in now 16 states around the country. Just got licensed in Ohio. Very excited about it. We are moving into a direction, folks, in our overall program, not here so much, but in my office, of looking at more creative ways in which we can help our clients protect their assets, both in the retirement space, long-term care space, and frankly in their health insurance, by looking at more creative ways in which we can position their health plans to help them save money. It's not a perfect world. God knows there's a lot of moving parts with these things, and you have to pay attention. As my partner Sean would tell you, Bill talks about contracts. As I pointed out to a client of mine just before I came on the radio show today, rates don't pay claims, contracts do. Whether it's an annuity, long-term care, life insurance, health insurance, disability, vision, dental, the contract pays the claim, it's not the rate. So if you're not getting a full disclosure of what it is that you're looking at, then you need to start asking questions or find a different advisor. In my world, I try to be as transparent as possible so the client understands what they're looking at. And hopefully, if you have your own advisor, they're doing the same thing. If they're not, start asking tough questions or start looking around for somebody else. And with that in mind, the man, the legend, the way of life, coming to you from the bunkers somewhere deep in Columbus, Ohio, or maybe Dayton, Sean Hauser.
You know, a lot of people in Ohio go, is this Columbus or maybe Dayton? So, yeah, there's some confusion around there, I'm sure.
Is that a reasonable confusion, Sean, that Dayton, Columbus, kind of next door to each other kind of thing?
Yeah, like totally don't look like each other. I mean, because Columbus is a big city, and Dayton is too, but Dayton kind of has a very small central district where Columbus has the state capital, then it's kind of got the business or the financial companies located. There's a lot of insurance businesses. Nationwide Insurance is there in Columbus, Ohio. So, but yeah, you have different centers, so it's a lot bigger. But,
well, you've got the Dayton Flyers in Dayton.
We do have the Dayton Flyers. Usually they're in postseason play right about now. They made it to the NIT this year.
Oh, I'm not talking. Oh, you know what? I'm sorry. I misspoke. I was talking about the baseball team, the minor league team.
Oh, the Dayton Dragons. Well, yeah, that's the Cincinnati Red affiliate that we have downtown. And boy, do I sound like an ad for the Chamber of Commerce, don't I?
There you go. Well, you know, we had the privilege, folks, of being able to go to a Dayton baseball game when Sean and Kelly got married, about a year and a half ago-ish? Right? Maybe 2 years now?
Oh, seems like forever. No, I can't say that. About a year, just over a year, and almost 2 years. Let's just say that.
Yep. So, anyway, did you, do I ask you if you caught any basketball games this weekend?
I did watch some of the games. In between, I had a lot of things I had to get done, but I like this time of year. I don't necessarily know all about basketball, but boy, they hear me talk, you think I do.
You know, I'm not a big fan of doing the brackets because I want to enjoy the game. You know, I don't want to be so caught up in, oh my God, my team's losing. Oh, my brackets are destroyed. I'm watching my kids, you know, they did 2 or 3 brackets, and, you know, after the first couple of games, their brackets are already destroyed because certain teams won and certain teams didn't. And I'm sitting there going, I'm just enjoying the games. I don't have to worry about who won, who lost, how much money am I going to lose. Although I will say I did win a pool one time in my life. I was in college, and it was 1981, 82. I was a senior in college, and I won the pool. I won the pool, and it was by dumb luck. We're watching the final game, and I forget who the teams were in 82, and the team that I picked won, and I looked at my pool, and I'm like, oh my God, I won. So, and I got some money for it. Honestly, I don't remember. It was probably more like pizza money, but in any case, Sean, welcome. Appreciate, as always, the pleasure of having you here, because as you know, I like to say I'm the mouthpiece and you're the brains. So appreciate you always being here, because when I start to go off the rails, you bring me back.
Kind of thinking about, like, is there a train analogy I should have had ready on the go there? But
one last thing I'll bring up. A couple things. Baseball. I know the Cubs and Dodgers played in Japan. I didn't consider that the start of the baseball season. Baseball actually starts Thursday. I think the Yankees are playing, and I forget who they're playing against. But Thursday officially starts the baseball season. There is a possibility that we may come down to Cincinnati. Sally and I are doing this round the world baseball stadium thing, and I've got you're in the Columbus Dayton area,
Metroplex.
I've got a cousin who lives, I think, in Columbus, and that's not that far from Cincinnati. So and
about an hour.
Yeah, my nephew is a senior and is a baseball player, so I'm looking at his schedule and seeing if we can make it work, that we can leave on a Friday, see a set, or maybe even a Thursday if I can get Sally to get a day off, and then head down to Cincinnati, go to the game, and then come see you guys, and maybe see my nephew and my cousin for a couple hours, and then head back. So we'll see how it goes. The schedule's tight because in May, the high school season ends probably mid-May, so we don't have a lot of room for error there. And then let me see, Ben. And then folks, I know we're going to have a couple more shows before this, but taxes are due April 15th, so pay attention. If you don't get your taxes done, file an extension, so at least you can stay out of the minimum of penalties that you may incur. And then one last thing. Engaging Time actually performed this past Friday, Sean. It was a gig with a whole bunch of other bands that were showing up. It ended up being some people didn't show and other people showed up, and it was a little bit chaotic, but it worked. I was the last person to go on Friday, and I was worried that my vocals would hold up. So for the first 3 songs, they worked, and by the time I got to the 4th one, things were breaking down, and the 5th one was a train wreck. But one of the songs I wrote, Sean, was a song called Prayers of a Child. And there were maybe 25, 30 people, I think, in the audience, and they were all leaning in, Sean, when I was playing this song. It was so cool to watch this. I didn't have the lyrics in front of me. I knew the lyrics. I knew the music. And I'm watching the everybody lean in, listening to the lyrics. I can tell, listening to the music, and I got the biggest ovation I've ever got in my life, and I was blown away by that. So, we'll see. I got to get to work on. I know I've been talking about this for 2 years. I got to get to work on getting that CD done so I can start promoting it. So that's it for the stuff that's going on. We're going to move on to the topic at hand, folks. We are talking about annuities tonight, and the 4 different types, essentially, of annuities, so that you can understand the differences. You understand why people buy them, why people don't buy them, who can qualify, what the penalties are there fees involved, those kinds of things. So Sean, before I get started, do you have any questions in that regard?
Oh, those annuities, they're scams. They're a ripoff. You should never buy them. Call for our new brochure and blah, blah, blah. You know, it's funny because you and I have talked about annuities on the show many a years.
Yep.
And different times for different reasons. And you go out in the marketplace and you got all these people that are out there that are just like so down on annuities. And yet when you start to ask them questions such as, well, you know, what do returns look like? How much conceivably could I have for retirement? Well, you know, I can't necessarily say that, and that's when you start getting all the backpedaling and talk, because unlike an annuity, they can't guarantee that you'll have 1 penny more tomorrow than you do today, where an annuity has that built into the contract.
That's perfectly said. I could not have said it any better. That's why I say I'm the mouthpiece and Sean's the brains. So he said that way more eloquently than I can. And I'll just add one extra piece to that. No matter what the financial advisor says to you, if you need X number of dollars a month, let's just say it's $10,000 a month you need, that's $120,000 a year, and let's assume that's net, not gross, that's net. So that really means after, before taxes, you're probably going to need $150 unless you've got everything in a Roth IRA, which is not likely. So if you need $150 net, round numbers, $120, that's great. And as long as the markets are going up, everybody's happy, there's rainbows and dogs yarping and the grass is growing and there's no rain. And then comes the correction and your portfolio takes a tank. And you asked about keeping some of your money safe. And the advisor who was more interested in assets under management and not protecting your portfolio did the song and dance of this is why we're not going to do that, or whatever they say to try to deflect you from that. At the end of the day, I've said this a lot, pools of money don't pay the bills, income does. Social Security is fixed like a pension. You're going to get that no matter what, assuming the Social Security system stays afloat. If you have a pension plan, you're going to get that so long as the pension program is going to stay afloat. With an annuity, depending on the kind of annuity you buy, you can, as Sean said, you can have a guaranteed income for life. Now, it depends on the quality of the company and the contract. All of that is really important, so you really have to do it. The advisor has to do a deep dive as to what the client is wanting, needing, and to give them peace of mind so that every month they know that check is going to come no matter what. So let's talk about the 4 types of annuities I want to chat about tonight. One is a fixed annuity. One is called a MYGA, which is an acronym for a multi-year guaranteed annuity, MYGA. Another one is a fixed indexed annuity. And then the last one is a variable annuity. So let's talk about the fixed annuity first. A fixed annuity can be one of 2 things. First of all, it's more of a parking lot. It's money that you want to park, that you want to guarantee for a period of time, and you don't want to think about it. Now, there's a couple things you do have to think about with regard to a fixed annuity, and that is, first, does the contract guarantee a rate of return that it's illustrating from the first year to the last year that you have chosen for the period of time you want that money in the annuity? So let's say you're doing a 5-year fixed annuity. And on the rate chart, it says we're going to guarantee you a rate of return of 5.2%. Great. Is that the first year and then it is whatever the market's doing in the second year, or does it guarantee you that 5.2% for the 5-year period first? So that's really important. I've seen both, Sean, where the fixed is fixed only for the first year and then we'll let you know in the second year. That's kind of a dangerous play because people hear what they hear and they don't necessarily, and it's not their fault, but they don't take a step back and do a deeper dive as to what happens in the second, third, and fourth years. And if the advisor doesn't tell them, and the next year you're only getting 4.8, you're going, what happened to my 5.2? So you really have to pay attention to the language. The second piece of this is the fact that there are no fees in a fixed account. So you're holding it for a period of time, and either you're getting a 1-year rate guarantee or you're getting a guarantee for the 5 years. But you got to pay attention to that. The quality of the company, folks, is this is me. There are other advisors that are willing to sell substandard carriers. I won't do it. I just cannot go there. So I saw a rate today, Sean. I forget the name of the company, but it was 5.65%. That's really good. That's really good, especially in the market where interest rates are starting to tick down, and insurance companies, many of them are ticking down their rates of return from 5.2 to 4.8 to 4.9, etc., because they see the T-bills dropping, they see interest rates falling, inflation is, I don't think it's under control, but they're claiming interest rates are going down. So the insurance companies have guaranteed your money, and they can't take that much risk, so they immediately drop the interest rates. And then I see this 5.65. So when I saw this, I reached out to my wholesaler, and I'm like, who is this? And she told me, I'm not going to say who. And she said it's a B-rated carrier. I'm like, oh, figures. Now,
so talk about that.
Okay.
B-rated carrier, right?
Oh, hold on a second. Hello, this is WLCB 101.5 FM. This is Bill Miksch speaking. How can I help you?
Hey, Bill, it's Dave at Imports Unlimited.
Dave, you're on the radio. Don't say anything bad.
Oh, I didn't know that.
Yes, you are. Sorry, I didn't mean to put you on the spot, but it's the first time somebody has called in on my cell phone, so you're the first one to be on the radio show for the 4.5 years I've been doing this.
Wow. Well, I hope you're having a good night.
It's a great night. I'll call you back after the show's over.
Not a problem.
Okay. All right, thanks. I was hoping it was Randy.
Oh, here, I thought we were going to get into a good, juicy discussion about annuities. But
No, he's actually got one, but he's got a Medicare question, and
I gotcha.
Yeah, so I didn't want to get it. I'd be violating about 10 different HIPAA things for the stuff I had to talk to him about.
Yeah, got to be careful about those HIPAA.
Yeah, baby. So
Insurance Protection and Portability Act, for those of you who are wondering what a HIPAA has to do with anything we're talking about.
Yeah, right. And most of those people can't spell the word HIPAA and the moving parts. And the danger part of HIPAA is when they're not sure, they just drop HIPAA on you, and that they think that's the way to get rid of the advisor or the client. We can't tell you that's a HIPAA violation. Mm-hmm. You people can't spell HIPAA. You want to pay? We started talking about A and B rated carriers, and Sean, you asked a question. Let's talk about the B rated companies. Is that where you wanted to go? Okay.
Well, you talk about a B rated company. What does that mean if I'm a buyer? Because the rate sounds great.
The rate sounds good, but the companies like Moody's and Fitch and S&P have looked under the sheets of all these companies to see how much revenue they've got, what kind of reserves they've got, where most importantly, where their money is being invested, and how they're doing the investing of your money, because it's your money. And keep in mind, folks, when we talk about annuities, with the exception of variable annuities, these are guaranteed monies that the insurance companies are guaranteeing that you are not going to lose your money. And so the issue then becomes, what is the risk level of that insurance company? Are they managing their portfolio well enough that they can take a risk and show you a 5.65% and not have to blink? Or are they doing that to entice investors to put money in their accounts so that they can build up their revenue fees and they'll figure it out later. And it's the latter that I think, in my opinion, that's going on. Those companies are B-rated for a reason. Their balance sheets are not as strong as an A-rated carrier. Their investments are a little sketchy in some cases. And this is not me, the advisor, or even Sean, who is a deep financial background. This is the professionals looking at those carriers, again, Moody's, S&P, Fitch, some others, that have done an assessment of those books and the portfolios and the book of business and made an assessment that, well, I'd like to give you an A- rating, but I can't. So you're B plus or you're B or worse. Now, what does that mean to the buyer? That means to the buyer that if they're B-rated, that doesn't make them a bad company. It's just that their balance sheet is a little bit weak compared to an A carrier. At the same time, if it's that weak, are their investments at risk of blowing up such that the insurance company could potentially end up in the worst case scenario in receivership, which means the $100 or $200 or $1 million that you gave the advisor to give to that insurance company, now you stand in line and hope to get 10 or 20 cents back on a dollar. You hope. Annuities are not. Annuities are not insured by the like a bank account, or even in some investment accounts, the SIPC. These are backed by the credit ratings of those insurance companies, and if they falter, the clients that have money in those accounts are going to end up basically as a general creditor. So contracts mean things, but ratings also mean things. If you're willing to take a flyer and buy that higher rate of return, and you don't care about the quality of the company, all I can say is buyer beware. As an advisor, Sean, I just won't go there. I want to sleep at night.
I think it makes sense. When you talk about, you think about it, it's like an investment, right? You can invest in General Motors, and, there's track records, so the chances of them being able to pay a bond that they issue, that you buy from them, might be a lot greater than Sean's Automotive that just started making cars yesterday.
Yep.
So
absolutely. In fact, what's that movie with Leonardo DiCaprio where they're selling penny stocks?
Wolf of Wall Street?
Yes. I saw a commercial about it, and there's a bit in there where he's coming from this big brokerage firm and he gets 1% override commission, and the guy who's showing him the so-called pink sheets, you get 50%. So if I sell a $10,000 stock, I get $5,000. Yeah, that's basically how that works. And then, fast forward to he's making a phone call to somebody. He talks about this company called Aerodyne, and it's a garage that looks like it's in Englewood. And he kind of blows it up. Now, I'm not beating up penny stocks. Don't misunderstand. I bought some in the past. I don't sell them. Some things are good. It's always do your homework, folks. Don't just don't just leap into the deep end going, oh, I'm going to get rich overnight because these penny stocks are going to go crazy. With insurance companies, you just have to pay attention. It's always the same thing. If you buy cheap, you get cheap. If you buy an underrated carrier, you just better have your peripherals on to make sure that company is going to have staying power. So fixed accounts also have what's called a free withdrawal period. So you can buy a policy that is a 3-year, a 4-year, a 5-year, a 7-year, a 10-year. I won't go past 10 years. There used to be annuities, Sean, you can go outwards of 25 years. And let me just say, anytime you have a surrender period, this is called a surrender charge, and it's 25 years, who do you think benefits the most from a 25-year surrender charge?
insurance company would, right?
Nope, the agent. Well, the insurance company too, because they got your money for 25 years. The agent just made the highest commission they can possibly have because that money is going to be stuck with the insurance company for 25 years. So the insurance company can afford to pay him buku bucks in the commissions. So for me, in my office, in our practice, we will not sell anything greater than 10 years. Just can't, again, for the same reasons, for B-rated, I can't do it. Just can't go there. One last thing, fixed accounts, fixed annuities generally don't have fees. It's a parking lot for your money while you're determining what you're going to do with it. Now, I'm going to talk about MIGAs, and we're going to compare the two in a second. A MIGA is a multi-year guarantee account. The biggest difference between a fixed account and a MIGA is that if I quote you 5.2% and it's a 5-year contract, you're going to get 5.2 guaranteed compounded for the next 5 years. Period. Full stop. No questions asked. Simple, easy peasy. These are parking lots for this kind of money. It's money. It's not all of your portfolio. No advisor can take 100% of your portfolio. It wouldn't be allowed for a lot of reasons. We'll get into that in a few minutes. But for the portion of the money that you want to keep safe and you want to park it somewhere and not have to think about it for a while, this is a nice place to put some of that money. How does it compare to a money market or a CD? The CDs are, this is money that annuities compete for. Banks are generally going to be lower than an annuity, but CDs are going to be shorter term, 3 months, 6 months, a year, 2 years. Maybe in the out years you can buy a longer term CD depending on interest rates, etc. Money market, same thing. CDs aren't liquid per se, but they sort of kind of are. The only thing you're going to lose is the interest that you would have earned if you let it go to maturity. With money markets, that money is available immediately, so those interest rates are not going to be as competitive as a CD or an annuity. An annuity, by its nature, Sean, is not a liquid asset. Because of the surrender charges that are baked in, there's a penalty for getting out. The only exception in these two situations is a death of the owner or annuitant. If you die and whatever the account is worth at the time, the family or the beneficiaries get what's left. If it's a joint annuity, the surviving spouse can make a decision to say, okay, just roll it over, I'll take it over, particularly for those that are IRA kind of situations. So a MIGA is a guaranteed, same kind of rules in terms of terms, 3 years, 5 years, 6 years, 7, 8, 10, etc. Again, I haven't run across anything that's past 12 years in some of the research I've done, but my wholesalers know that I won't look at anything greater than 10. Again, I mentioned a parking lot. These also have a free withdrawal period, which means after the first year, you're allowed to withdraw between 5 and 10% of the principal, no questions asked, no penalties. So if you dropped in $1 million and it was a 10% free withdrawal, theoretically, after the first year, you could call the insurance company up and say, give me $100,000, and they would have to send it to you, and they can't surcharge you or hit a surrender charge with you. If it's an IRA, you're going to get taxed on it. If it's a Roth IRA, you're not. And if it's non-qualified money, I'll get into the taxes in just a couple minutes with regard to that. So we're at the bottom of the hour, Sean. We're going to take a quick break here, and then we're going to get into fixed. Actually, we're going to compare fixed and MIGA, and then we're going to get into fixed indexed annuities, which are a different animal altogether. But with that in mind, my name is Bill Miksch. I'm president of WDMA Financial Group in Grays Lake. That's Sean Hauser. We'll be right back after these short messages.